I would not be surprised. I mean, if we get, say, a slightly more cautious approach from the Fed on interest rates tonight, what we could see perhaps is an opportunity to hit gold back under the $2,000 level. And I would expect in that case, it might bottom out around about the 1950, 1960 area, which is roughly where the 200-day moving average is. So that would be, if you like, a normal technical reaction. Central banks basically are trying to get out of paper currency. That's why they're accumulating gold.
The gold price is trending downward from the zone of favorable sell prices, ranging between $2,101 and $2,050. The downside target is set at the low observed in December 2023, with an intermediate take-profit target aligning with the low recorded on January 17th. However, Alasdair Macleod, head of research at Gold Money, suggests that a more cautious stance from the Federal Reserve on interest rates could prompt a decline in gold prices, potentially pushing them below the $2,000 mark. He anticipates a bottoming out of $1,950 to $1,960 in line with the 200-day moving average, a standard technical reaction. The recent dip in gold prices can be attributed to the U.S. Federal Reserve's announcement, which dashed hopes of a rate cut in March, emphasizing their commitment to a 2% inflation target. This move bolstered the dollar index, DXY, diminishing the appeal of gold. In the broader context, central banks, governments, and monetary authorities continue to hold gold as a crucial component of foreign currency reserves, affirming its significance in the global financial system. Recent years have witnessed central banks acquiring more gold than they sold. Gold's high liquidity contributes to lower price variance. The World Gold Council predicts that total gold demand will expand further in 2024, citing the potential for the U.S. Federal Reserve to cut interest rates, which could positively impact prices. Last year, gold consumption reached a record high of about 4,899 tons, with strong demand in the opaque over-the-counter market and sustained central bank buying. Alasdair Macleod underscores the role of gold as a hedge against the weakening purchasing power of paper currency. He points to factors such as escalating U.S. Treasury debt, rising interest rates, and an impending debt ceiling adjustment that could result in a staggering $40 trillion in outstanding debt by January 1, 2025, prompting central banks to accumulate gold to reduce dependence on paper currency. We will present clips from Alasdair Macleod's interview with Liberty and Finance. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
The level of interest in gold is virtually zero, yet we're close to all-time highs. I mean, when has this happened before? I was interested to see that the open interest on the COMEX contract has more or less collapsed in the last 3 or 4 days. I mean, it's gone down from something like 500,000 contracts down to, I can't remember, it's something like 430,000 contracts. I mean, it's just literally fallen like a stone. I would not be surprised. I mean, if we get, say, a slightly more cautious approach from the Fed on interest rates tonight, what we could see perhaps is an opportunity to hit gold back under the $2,000 level. And I would expect in that case, it might bottom out around about the 1950, 1960 area, which is roughly where the 200-day moving average is. So that would be, if you like, a normal technical reaction, though, for the perennial gold bugs, they will scream blue murder, but they always do. But other than that, we have to look at the fundamentals, and the fundamentals. We're not talking about fundamentals for gold, other than what the central banks are doing. The central banks basically are trying to get out of paper currency. That's why they're accumulating gold. The central banks are trying to get out of paper currency, which is why they're buying gold. And it's paper currency that we've got to look at. Paper currency is losing its purchasing power. I mean, we've already spoken about the position of the dollar, where you've got a debt trap. I mean, just look at what's happening to U.S. Treasury debt, the debt mountain, and rising interest rates. What's that going to do to it? You can see that, I reckon, by the time the new ceiling is fixed, which is due to be done on January the 1st, 2025, we could be looking at total debt outstanding in the region of about 40 trillion. I mean, it's, I kid you not, just look at how this is going. And that's the sort of number we're talking about. So, the US government is in a debt trap. And we've also got a banking crisis, which is underneath the surface most of the time, but occasionally it just bubbles up a little bit, as we've seen with New York Community Bancorp. The economy itself, if you allow for the fact that roughly in this fiscal year, roughly 3 trillion of excess currency is being produced by the government, which is going almost all into the GDP, then that's inflating the GDP nominal number hugely. So, if you're going to end up with, say, GDP rising, a nominal GDP rising by something like 4% or something like that, actually, what you're saying is that the private sector GDP is contracting. And if you look at what's going on around you, the small and medium-sized businesses, which make up actually the majority of GDP, then you can see that, that's actually what's going on in the country.
As the regional bank New York Community Bancorp stock faces significant declines, the Federal Reserve's recent signaling indicates a shift in its concerns about the U.S. banking system. In its official statement, the Fed omitted any reference to the banking system, marking the first instance since the previous spring year when it had expressed vigilance over U.S. financial conditions. The Fed's heightened worry about the banking system emerged following a series of regional bank failures in the spring of 2023. Subsequently, the absence of further failures can be attributed in part to the Federal Reserve's establishment of an emergency borrowing program for banks. Alasdair underscores that the challenges within the banking sector extend beyond specific institutions, using the example of New York Community Bancorp to indicate that the underlying issues persist. Alasdair attributes the tightening of bank credit to apprehensions about lending to businesses amidst challenging economic conditions. Small and medium-sized businesses are struggling with cash flow problems, approaching banks for overdrafts, where they are either declined or offered such facilities with additional collateral requirements and higher interest rates. Let's get back to the interview.
The problem with the banking system is that when banks basically are overstretched and trying to reduce the risks that they face, then things start going wrong. And I'll give you another example. We've had the Evergrande collapse in the Hong Kong courts, where it was ruled that the proposed reconstruction wasn't going to work and so on. As I understand it, the value of Hong Kong property has taken a bit of a dive on it. Now, this makes one wonder. I'm sitting in the UK. We've got two banks in the UK which are very heavily involved in Hong Kong. Hong Kong Shanghai Bank, obviously, which now calls itself HSBC, and Standard Chartered. These are two banks very, very busy in the Far East and particularly in Hong Kong. So I would not be surprised to see that questions will be asked about their solvency and so on. So that's likely to begin to impact the banking sector in the UK. I think there's nothing really specific. When you get New York Community Bancorp getting into trouble, we're not talking a major bank or anything like that. I have no idea what the size of the balance sheet is, but I don't think really it's all that important. But I think it's just the indication that this problem has not gone away. The interest rate outlook, I think, is being driven as much as anything by the tightness of bank credit. Why is bank credit tight? Well, bank credit's tight because banks don't want to lend money to businesses because they see business conditions at very, very best stagnant, and at worst, particularly up and down the country, small and medium-sized businesses are struggling and they need cash flow replacement, and they go to the banks in order to have an overdraft. And the banks are basically saying either no, or if they do offer overdraft facilities, it's with goodness knows how much extra collateral and all the rest of it, like directors' houses and so on, that they have to put up for collateral. And on top of that, the rate is high. So this idea that interest rates are falling, forget it. When you get a shortage of credit, the rates actually rise. And I don't see anyone actually fully understanding this. So the banking problem, I think, is a global problem. It embraces not just the American banking system, but also the Euro system, Japan. And Japan has been trying to sit on bond yields because it knows that if bond yields rise, not only does that make the situation as far as the Bank of Japan is concerned really frightening, but also Japanese banks are very highly leveraged. I mean, they've got asset to equity ratios in the region of 20 times. I mean, that is staggering. You don't normally get at the top of the lending cycle, you don't normally get it that extreme. And so, I mean, it got there basically because negative interest rates basically compress the margins. And the only way you protect the bottom line as a banker is you leverage up your balance sheet. That's what they've done. And now, we're going to pay the cost. New York Community Bank Corp is a bit of a canary in the gold mine. In the banking industry. So that, I think, we could be about to embark on another round of concerns about the banking system. And I think it is global. So that's going to start filling the headlines again, in my view.
Despite the reduced chances of an imminent rate cut, gold is still set for a weekly gain, as these expectations have been mostly factored into its price. Is gold poised to maintain its value amid economic challenges, or will external factors reshape its market trajectory? Share your thoughts in the comment section below. If you find this video informative, remember to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.